You're watching Earnings Central right here on NDTV Profit, and today we're going to be discussing the earnings of HCL Technologies. Quarter 3, as always, has surprised the street on the positive side, and I've got with me Mr. Anant Gupta as well as Mr. Anil Chanana to run us through the performance of this quarter. Once again, and not a surprise, I mean, even after what Infosys did, the street did not change its expectations from HCL Tech, and you're starting to believe that with the kind of performance that you're posting on a quarter-on-quarter basis.
Great. All I can say, it's good. I think we've been having the journey is not obviously a single quarter performance. It's been a journey over a period of time. Our conviction on the fact that the rebid market is a market which will really be the opener. Even though in the initial periods, 2 years, 2.5 years back, it may appear to be margin dilutive, but that's really the place where the growth's going to happen. So if you look at it from a growth perspective, I think 3.2% sequential growth once again on a constant currency, 3.8% is phenomenal on one side. Given that 2012 was really a year of significant uncertainty and challenge in the overall market. Even if you move on to the EBIT profile, our EBIT this quarter moved up by 10 basis points to 19.9%. It's been a sixth quarter of net margin expansion, standing at 16.2. Even if you take it from a period ending March and last 12 months, both on the revenue side, it's grown by 14.6%. And if you take net margin again, period ending March for the last 12 months, it's up by 51.5%. So I think overall our strategy continues to deliver. We continue to remain bullish around the market sentiment with respect to rebid, and therefore we continue to use the expansion in margin profile to invest back into growth areas.
It's working both ways for you. While you have your deal pipeline maturing on one side, which is also adding up, on a quarter-on-quarter basis, the quantum of large transformational deals that you're getting also does not fall below that $1 billion mark.
Well, and it's good because the market is there. We've always said, and even if you look at the TPI data, right, that the calendar year 13 is expected to see a rebid market of about anywhere north of $50 billion. The same trend going into calendar year 14. So we continue to selectively participate in that market where we believe we can add value to the customers in there, and that's what's driving our $1 billion book profile. So one is the rebid side. So if you look at 90% of our deals was from the rebid side, close to about 50% of that were integrated deals. So our belief on both the rebid, the integrated story between application and infrastructure continues to be strong, and we continue to deliver value by driving both those service lines together. So
it's working well.
Yes, it is working well.
Anil, margin 6th quarter in a row, the expansion. I mean, you want to comment on that? And obviously, this is a big area because it's not just one particular vertical, one particular business. You've been seeing expansion and contribution coming in across the board.
You're right. I mean, this is coming in the infra business, this is coming in the software business as well as BPO business. So all three businesses have shown a margin resilience. The reason being the investments which have taken place in these businesses which are yielding results. So if you look at the infrastructure business, where there are new deals coming in and moving into mature stage, so we wanted to make sure that the transition happens correctly and in time, and therefore we over-invested in the initial phase. And now, as they're moving into a mature stage, a steady state, we are getting the benefits of that. Similarly, if you look at the software, we decided to invest in areas like risk and reward there in terms of the engineering R&D services, in terms of the implementation services, package implementation services. So we are getting the benefits of that are also flowing in at this point of time. So essentially what we have done is created a unique model in itself, which is away from manpower and more value. I mean, what is the value addition we make for our customers? So that is the focus of our business model.
So it's going to be a blend of new business as well as transition and maturity of the pipeline that you already have. All right.
And maybe just to add, and this is the point we've been saying for a while, that we will continue to drive non-linearity. The relevance of revenue and profitability has really the correlation between manpower will continue to diminish over a period of time as we look into the future. So if you look at our fixed price, managed services, outcome-based revenue profile, it's up to about 53.2, which is up about 4% from the similar period last year.
And that's the model which is the market is moving towards, the industry.
And that's where the market is moving, right? Because in generation one outsourcing, whether it is application services, whether it is BPO, whether it's infrastructure, or whether it's integrated, the initial phase of Gen 1 outsourcing was all about labor arbitrage, productivity, automation to some extent in there. So that was really what was driving that. But as you move more towards Gen 2, those levers have been exhausted, right? And therefore, customers are looking at what will drive the next level of let's say, business case for them. And that really will come from multiple such models, right? One is either it's outcome-based, it's risk-reward, which is more engineering-led, which is participation in the risk of the product for the technology company in the market, and therefore taking a higher upside. Or if you look at the ES portfolio, the templates we talked about, the IMRO or asset management, which Steve has previously talked about, which is very useful in large-scale global consolidation programs, so which is all steps trying to drive non-linearity in the business.